Alrighty, looks like we're live. So let's chat today about the cost of living, because the cost of living is real and so are these strategies. There's no sugarcoating it. The cost of living is up. Most Aussies are feeling it. But if you know how to use your mortgage, your property, and your timing wisely, there's a smarter way through. So tonight, I'm going to walk you through three things. That's right, three things. How to stop wasting money on your mortgage, how to build real income through smarter property. Let's try it again. Number two, how to build real income through smarter property strategies, and how to navigate the market with a long-term view, especially with interest rates expected to shift. I'm Gaurav Gupta, CEO of Ethical Property Investments. We help everyday Aussies build high cash flow, ethical property portfolios that do good and make money. Now, here's the thing. It's properties and beers time. So if it's your first time, welcome. If it's your 50th time, welcome as well. We do something interesting at properties and beers, and that is have some sort of alcoholic, usually it's alcoholic, sometimes it's non-alcoholic beverage to start off with. And today is a rehashing of a favorite, so whiskey dry and lime. This is the 6%, no sugar, gluten-free. Let's give it a go. Let's crack it open. Well, cheers, guys. Wow, that you can definitely taste that a little bit more compared to the 4% version. It's definitely a bit stronger. When I get this version, the 4%, taste-wise, I actually prefer it a little bit more like the 4% version. If I'm having whiskey that's strong, I like it on the rocks, and maybe it's time to get back to spirits. It's getting a bit colder, so it's a good time to get back to spirits. So I might actually start bringing the spirits back into properties and beers. Here we go. So if you've got any questions, feel free to drop me a chat. More than happy to answer any of the questions that you guys have. Now, let's chat about what's next. So here's the thing, right? If you've ever been stuck in a 30-year mortgage or really struggling to make your property actually pay for you, stay tuned. We've helped people get ahead much faster than they ever thought possible just by doing things a little differently. You know, a lot of people just accept that a 30-year mortgage is normal, but what if it doesn't have to be? And so in part one, let's chat about killing your mortgage faster without killing your lifestyle. That's right. So most Aussies don't realize that they're handing over $300,000 to $500,000 extra in interest over 30 years, and it's avoidable at the end of the day, right? I think it's just absolutely silly that most people do that. And we're not talking about refinancing 2 years or chasing lower rates. It's actually about having a game plan that works in your favor. And here's the thing. If you're staring down the barrel of an extra 20 years of extra repayments, you really want to hear about the other way. And did you know that the average person pays over 15 years of mortgage repayments in just taxes? That's crazy, right? And here's the thing. The word mortgage really just stands for to engage until death. Fun stuff, right? Well, maybe that's why it's 25 to 30 years, just like life in prison, which is what mortgages feel like for some people. And here's the thing, right? With our mortgage terminator strategy, we've actually worked with hundreds of people to focus on your mortgage, right? And to help people pay down their mortgage in 10 years or less, saving quite literally hundreds of thousands of dollars in interest repayment. And it's just a matter of structuring as well as the right advisor. That's why it's key to have a mentor on your side, because once your mortgage isn't chewing up all your income, you free up other choices, right? And that's really important to know, because the next step, which is really part two of our session today, right? It's about building real income with high cash flow investing. Look, you've probably seen rents go up, but what if I told you some investors are earning double, even triple, and in some cases quadruple what standard rent brings in? That's where strategies like co-living and NDIS SDA could completely change the game. Now, here's the thing. There's a difference between buying a property and building a strategy. That's where the cash flow game really changes for you. And here's the thing, right? The first time I saw co-living almost 10 years ago, I thought the rent income was a mistake. It wasn't. It was just smart design meeting the real demand out there. And even more so with the rental crisis we have, co-living is more and more really the flavor of the investment flavor of the choice of most people. Because here's the thing: we've got investors, instead of earning, $3, 4, 5, even $600 in a regular property, they're earning between $1,250 to $3,000 a week with co-living strategies. And here's why that matters. I believe co-living is a smart response to modern housing needs. It meets a growing tenant demand for affordability, flexibility, as well as a shared community, while getting the investor unmatched returns for the ethical investor, right? I believe the average person does really want to solve the housing crisis, and co-living is the best way to do it. And you can do it while actually making money, because when designed correctly, with the right tenant experience, council compliance, and investor returns in mind, I believe co-living can turn an ordinary home into a high-performing, purpose-driven asset. And just to be clear, we like to build purpose-built co-living, not turn from scratch. So, but if you've got equity and you're looking to invest, and you're saying, hey, maybe I should invest in a regular property, well, I think you'd be silly not to consider co-living instead of a regular property. But that's, I'm not providing financial advice. I don't pretend to be a financial planner on the internet. I'm not pretending to be one now. So do your research, of course. By the way, if you're watching, drop me a line, say hi, ask me a ton of questions. So part three of our session today is about long-term mindset and rate changes. And because timing still matters, there's a lot of people who panic about interest rates. But what if we're about to see them drop 3 times this year? Because that's what the KPMG report is saying, that we're expecting 3 more rate drops a year. And yes, property is a long game. And the people who generally win don't react to headlines. They follow a strategy that works across the ups and downs. And at the same time, with the interest rates being where they are, headed downwards, I believe rate-sensitive markets, and I've said this before, I'm going to say this again, rate-sensitive markets like Melbourne are going to grow much more than expected, because we've missed a rate growth here. We missed growth here in Melbourne, and that's about to change. That's already changing. So if you haven't got your ass into gear for Melbourne, don't wait to do it in 2, 3, 6 months' time. Like, it's pretty much already too late. You better get in before it starts running and you're buying at the peak, right? Because that's what most people do. They sort of go, hey, this place has just gone up. Maybe if I buy there, that's when I'll make money. And that's not how it works. You really got to get with a proper mentor who's been there and done that and say, okay, where in your opinion is it going to go up and why? It was interesting. I was getting people 8 years ago saying, hey, I would never invest $350,000 on a house in Gold Coast. And boy, when those houses are now worth $800,000-$900,000 in today's money, guess what? All that time ago, there's people that wasted hours trying to digest that information. It was them that lost out at the end of the day, because my clients and myself, we invested in those places, and that's really important to know that it's important to work with the right team. And look, I get it. When rates went up fast, they really hurt, but now the tide's really turning. So the question is, what you do now, what will you do now that'll matter more than what happened last year, right? Because the key here isn't to predict perfectly, it's to position strategically. Now, we used to be called 10 properties in 10 years. The reason why we changed that is because you actually don't need 10 properties or a multi-million-dollar portfolio anymore. You need A, the right structure, B, the right location, and C, most importantly, the right guidance and mentoring, right? And be careful who you get your guidance and mentoring from, because, of course, everyone's got some sort of vested interest. I have a vested interest. The other person has a vested interest. So ask them, what are you invested in? Show me what your strategies are. And that is the key on how you pick the right mentor. Show us your wins. Show us your losses. Show us what hasn't worked for you and your clients. And show us what has worked, and then make up your mind, right? Now, it is really important to know that the strategy is still yours, and so you've got to do your due diligence and research. But here's the thing. As we close today, before we get onto some more beers, that's right, here's an invite for you. We're going to put co-living on trial on July the 15th. This is where we take it deeper. Maybe you've been curious about co-living, or you just want to know if the strategy really holds up in today's market. my thing is, we're going to put this on trial, right? This is not the mushroom trial or the Diddy trial, right? Just for a bit of fun, we're going to put co-living on trial and see if it's all it's cracked up to be, what works and what doesn't work. We're going to do that on July 15th. We're going to put co-living on trial, and we're going to break it down like never before. Really, real numbers, real example, and real talk about what's working and what doesn't. We did an in-house session with our clients the other day, and it was so powerful. They said to me, "Hey, Goro, did you know we feel that co-living is actually safer than regular houses?" That's just crazy, right? And the reason why they said that, actually, come to the webinar on July 15th. I'll tell you why. But there's reasons why we had multiple people on the webinar, people who spent 3, 4, 5 years in the co-living space say, hey, this is a safer strategy than regular houses. I mean, that's crazy, right? So we're going to put a registration link in the comments for the webinar. And look, if you haven't already, follow us on Facebook at Ethical Property Investments. We post the updates, the case studies, and the real answers you won't get from the mainstream media. Thanks for being here, thanks for being here. And as always, invest smart, stay grounded, do good, make money, and repeat. We'll see you soon. Cheers, guys.